Hello, this is Wes Shannon, and thank you for watching the second video in our four-part series, Understanding Markets. Today we're going to talk about the types of investment risk. Before we get into that, let me introduce myself. I'm Wes Shannon, a certified financial planner and the founder of SJK Financial Planning, a fee-only registered investment advisory firm in the Dallas-Fort Worth area. And this video is for education purposes. I'm not making recommendations for any particular strategy for any particular client. All the different risks that investors face can be put into two categories: unsystematic risk and systematic risk. And I'll get into the details here on the next slide. Unsystematic or diversifiable risk are unique risks that apply only to an individual security or investment or to an individual industry or a country. These include business risks. Maybe business is not good for a company due to a change in management or a different philosophy, or maybe competitors have horned in on the business market share. Financial risk. Maybe a business lost their line of credit, or maybe there's been some improprieties with the money. There's several things that affect the financial aspect of any investment in any business. Default risk. If you're buying a bond, what if the bond issuer can't pay the bond back? That's called default risk. Political risk. Let's say the laws have changed that make a way of doing business obsolete or ineffective, or a product is no longer needed because of some change in the political scene. Investment manager risk. If you're invested in a mutual fund or exchange traded fund, if there's been any change in the investment management, then that's a risk that an investor faces. And liquidity is a risk. Maybe you need your money quickly. Well, some investments like real estate are very illiquid, and it takes a while to get your money out of the investment. And finally, marketability risk. Let's say you invested in some investment that there's not a good market set up for it, so when you get ready to sell it, it takes time to try to find someone to buy that investment from you. Now, the good news on all of these types of risks, they can be totally eliminated with proper diversification of a portfolio. Now, systematic risk or non-diversifiable risk, these are things that are inherent to the broad investment market, and we cannot eliminate these by simple diversification. These risks involve inflation, reinvestment rate risk, where let's say you bought a bond for 10 years at 8%, but at the end of the 10 years, all you can get is 3%. That's investment rate risk. Interest rate risk is when you have an investment like a bond that's subject to fluctuations in interest rates. Bonds, if interest rates go up, the underlying value of the bond goes down, and vice versa. If interest rates go down, the underlying value generally goes up. Market risk, that's whether we're in a bull market or a bear market. Those are usually very temporary type events, but they are a risk to an investor. And then currency risk. If you're investing in foreign investments, then any fluctuation in the currency values can affect your returns. The good news is, while it cannot be eliminated, these all can be greatly managed and reduced with proper portfolio asset allocation. So what can a well-designed portfolio do for you? First of all, eliminate all of those unsystematic risk factors. And then second of all, try to reduce and manage the systematic risk. At SJK, we feel very good about our ability to create portfolios that fit our clients' needs and optimize them and reduce the risk. I appreciate you taking the time to watch this video today. Please follow us on Facebook, YouTube, LinkedIn, Twitter, and also visit our website at www.sjkfinancialplanning.com. Thank you.